Hey guys, AJ Hazzi here, and welcome back to the Vantage Report. We are in June of 2022 and things are changing. Today we're going to do a deep dive into the data, and I'm going to share with you what's happening in the Kelowna real estate market, and ultimately what does this mean to you if you're thinking about buying or selling real estate in a market that has entered a shift. Now, I've been talking about this shift now since the beginning of this year, and most of the things that I predicted have now come true, and we are seeing it within the data. We are now statistically in that first trimester of a shifted market. Now, what does that mean? Well, what it feels like right now is a balanced market. It is actually the ideal scenario for both buyers and sellers. If a seller puts their home on the market and it's priced intelligently, it will sell. If a buyer is shopping right now, they have a few options, and guess what? They can have conditions on the purchase of their home. They can get a home inspection. They can have time to organize a mortgage, all of these things. So back to what we consider a normal market. Now, the months of inventory, or the absorption rate, is the number one indicator that I always talk about in these Vantage reports. And you'll see that we've actually gone from just a little over a month's inventory, which is a very tight seller's market. That's multiple offers on everything, to a little over 2 months where still things were selling for over list, but it wasn't quite as competitive, to now we're just north of 3 months of inventory. And what that feels like is balanced. And a balanced market is in that sort of 3 to 5 months worth of inventory, maybe even 3 to 6. When we get north of 6 months of inventory, that's when we get into a buyer's market. So we're not there yet, but this is very much a pendulum effect. So we're seeing this trend, and I expect that trend to continue to where we get into a slight buyer's market. Even with 3 months of inventory, we are seeing some slight downward pressure on prices. One of the things that we notice is that for the first time in as far back as 2 years, the average list to sell ratio is actually below 100%. What that means is people are getting a slight discount. It's not much, but the average home is selling for just less than full price now. Also, we're seeing that homes going on the market are sitting on the market a little bit longer. You can see that the days on market has crept up ever so slightly from 24 to 27 days on market on average. These are slight changes, but you have to realize that the trend, this is the first time in months and months and months where we've seen a reversal of the trend. Now, when we look at the home price index, that is the average benchmark home, this is the first month since pre-pandemic time where we haven't seen big gains months over month. In fact, we've actually seen the benchmark home come back by about 1.6%. So you can see that price softening. There's price softening in the negotiations, and there's actual price softening based on the downward pressure that's come from the interest rates. That's what's happening. Everybody's curious what's causing this. Well, it's no secret that the Bank of Canada has been raising rates. In addition to those rate hikes, we're seeing the banks themselves have eliminated a lot of the discounts. And so we're actually seeing a pretty solid spread between what you could buy a home for this time last year versus now. So when you break that down, what does that really mean? Well, let's take the average single family home, for example, which is just over $1.1 million. Well, this time last year, you could get a mortgage for around 2.5%. which would allow you to finance this home for under $4,000 a month, which was cheaper than renting. Especially if you had a suite, you could probably have half of that offset by a tenant, and you were laughing. Fast forward to today, where the interest rates are closer to 5%, that's 200 basis points higher. That same home is gonna cost you $1,000 more per month to finance. And so what's happening is you're seeing a lot of people priced out of the market. When you look at, the average income of Kelowna is still only $68,000. At $5,000 a month, that would be 100% of the average person's income, household income, would go to the average single family home. It just doesn't compute. Now, if you look at the actual money you would need to earn to afford the average house, would be $140,000, and that would be if you had no other debt, no car payments, no visas, nothing. And so a debt-free person would still need to make $140,000, which would mean you'd have to have 2 earners in the household that were in that 75th percentile of income earners, making over $75,000 each. And so when you see the bottom end of the market get jammed up due to affordability, it does have a knock-on effect throughout. So we're gonna see that in the coming months play out. And what we're seeing today is that more and more sellers are looking to capture that last gasp of the seller's market. And so we're seeing more properties hitting the market than before. Every day when I check the hot sheets, I always look at the ratio between things that have sold and things that have been listed, and roughly about 2 to 1. We're seeing 2 listings for every sale right now. So we can expect that inventory levels will continue to rise. What's become clear is that the prevailing emotion of the market has switched from one of greed to one of fear. And this is because the capital markets, the crypto markets, all throughout the whole economic system, we've seen trillions of dollars of capital vaporize almost overnight, which has shot panic through the whole market. Now, our real estate market is holding up very, very well in comparison to all of the other asset classes. But we are not immune to when the whole world goes into a recessionary time. And it looks as if the world is entering into a recession. Now, the last time we went into a recession was 2008. And we saw a 20% drop in pricing thereabouts. And this was called the Great Recession. This was enough to send shockwaves through the market and put a lot of people in harm's way. Now, one thing to keep in mind though is when we look at a 20% reduction, just some perspective on that, we need to zoom out a little bit and we realize that last year alone, we saw over 30% increase year over year in our real estate market. In fact, over 2 years, we saw 58% increase. So if the market were to pull back by 20%, the headlines would be like pandemonium. People would be talking about collapses and crashes and all these things. But the reality of it is, when you really put it into perspective, you're only giving away about 8 months worth of last year's appreciation. And so although 20% would be catastrophic, and I don't see that necessarily happening, we would still have a net gain year over year of 10%, which is double the 50-year historic average that real estate appreciates. So we have to get out of this idea that real estate is expected to go up double digits per year, 20% per year. It's just not sustainable. At some point, there's going to be a pullback, and it feels as though we're entering into that. Now, how bad will it get? I don't know. No one has a crystal ball. One of the big things that led to the crisis of 2008, 9, 10 was foreclosures. And a lot of people are thinking, okay, they're money on the sidelines, they're waiting for all of these foreclosures to happen. Well, the simple fact is there's nothing on the horizon that suggests there'll be any foreclosures for a couple of reasons. Number one, the lending requirements over the last 4 or 5 years have been very strict, which means the people getting mortgages have all been stress tested to a higher rate, which means that they're not likely to find themselves underwater. Secondary to that is that you don't have a number of people speculating in the market that we had back in 2007 and 8 who are sitting on properties that are negative cash flow. That has not been the case. Banks have not been as apt to finance those, and we just don't have that much speculation in the market. Thirdly, people have so much equity. There's no reason for them to go into foreclosure. If they've been holding a property for the last 2 years, they've likely seen a 58% increase. There's zero chance that they're gonna see 58% drop. And so to find themselves underwater by the time their mortgage comes to reset, it's very, very unlikely. So the foreclosures were really what drove the market down as far as they did last time, and that's not on the horizons. Now, a lot of people are saying, well, maybe I'll just sit on the sidelines and wait, I'll rent for a while. And that can be a good strategy, that might work. However, as I mentioned before, it was cheaper to rent before. We still have tons of people moving to the Okanagan. And so lots and lots of people who could buy are opting to rent, which puts additional pressure on the rental stock, which we already don't have enough. If anybody's tried to rent a home recently, it is very competitive. Well, if you add to that that people who would have bought now become tenants, then you've got a very competitive rental market. And the other thing we're telling buyers, and not every buyer should buy, if you're thinking short time horizon, 1 to 2 years, you might not like where you find yourself in a year from now. But I bought lots of real estate in 2008 that I still own, and I did go through a bit of a period of time where I was upside down on it. The long-term hold on real estate has always been wonderful, and being able to own your own asset, go in and make it your own, force that appreciation by doing renovations, paying your mortgage off, and then just holding it. If you've got a 5 to 10 year time horizon, the likelihood of you being in any kind of trouble on a real estate investment is very low historically. And so people say, should I wait? Well, the answer is it depends. It depends if you're looking to flip, or if you're looking to only be in Canada for a couple of years and you're not sure. Probably you should just rent. But if you are taking a longer horizon, 5, 10 years plus on a property, then you're better off to just get your family situated, start paying your mortgage down, and creating that equity. For sellers right now, best advice I can give you is if you're planning to sell your home anytime in the next 2 to 3 years, now is going to be your best opportunity to negotiate the best price and terms for that property. Well, there you have it, guys. There's the market in a nutshell. If you're interested to know what your home might sell for in today's ever-changing market, you can start that process right here on the blog. And if you're interested in poking around now that there's some more selection out there to see what homes you might be able to purchase, you can start that process right here from our search tool as well. Thanks so much for watching, guys. Hope you guys got tons of value from it. If you like this kind of content, please do hit the subscribe button, and we will see you in a couple weeks.